Hey there, finance virtuosos. Today, we're diving deep into the world of stock market history. We're not just talking about the last few decades though, we're going all the way back to 1792. That's right, we're unpacking over 230 years of market data to see what lessons we can learn for our investing future. Now, before you yawn and click away, thinking this is going to be a dry history lesson, let me assure you, we're going to make this journey through time both enlightening and entertaining. So, buckle up, and let's start our financial time travel. This is the Finance Virtuoso channel, where we talk about all things finance. If you're new here, be sure to subscribe and hit the notification bell so you don't miss out on any future money tips and tricks. First things first, where did we get this treasure trove of data? Well, we have to tip our hats to Edward Macquarie, a financial historian who's done the painstaking work of compiling this near-complete record of U.S. stock market returns. And while we should take the very early data with a grain of salt, there are some truly valuable insights we can glean from these long-term trends. Now, in your mind you might be saying, okay, but how does 18th century stock data help me with my Robinhood account? Well, that's exactly what we're here to explore. Let's dive into some of the biggest takeaways from this data goldmine. Lesson number 1, patience pays off, but you knew that, right? Our first lesson might sound like a broken record, but it's worth repeating, patience in investing almost always pays off. I know you've heard this before. But stick with me, because the numbers here are pretty mind-blowing. According to Macquarie's data, in any given year, you have about a 26% chance of seeing your investments decline. That's roughly once every 4 years. But here's where it gets interesting, if you extend your time horizon to just 5 years, the risk of a catastrophic loss basically disappears. And if you can hang in there for a full decade, the chance of experiencing even a correction-level loss is pretty much gone. But wait, there's more. If you had the patience of a saint and let your investment sit for at least 20 years, historically speaking, you would never have lost money. Never. Not once in 230 years. Now that's what I call a long-term perspective. Of course, I can almost hear some of you saying, but what about inflation? Good point. While it's tricky to find reliable inflation data going all the way back to the 1700s, even when we adjust for our best estimates of inflation, the returns are still pretty impressive. How impressive? Well, if you had invested just $1 in 1793, it would be worth the equivalent of about $750,000 today. Talk about a return on investment. Lesson number 2, crashes happen, but they're usually not the end of the world. Now, let's talk about everyone's not-so-favorite topic, market crashes. Though crashes can be scary, they're usually not as bad as we fear. Yes, the worst crash in this dataset may have been during the Great Depression, when the market lost over 70% of its value. And the longest crash, also during the Depression, may have taken about 15 years to fully recover. But here's the silver lining, these extreme cases are the exception, not the rule. The median depth of downturns in this 230-year period was just 7.5%, and the median duration was only 1.5 years. Not exactly the stuff of nightmares, right? Now, I'm not saying crashes are fun. They're not. But understanding their historical context can help us keep our cool when the market starts to look like a roller coaster. Remember, you only actually lose money if you sell when the market is down. So maybe during those turbulent times, it's a good idea to step away from the financial news and binge-watch your favorite show instead. Lesson number 3, diversification isn't just a fancy word. Alright, let's talk about everyone's favorite financial buzzword, diversification. But before you roll your eyes, let me throw a curveball at you. We often think of diversification in terms of different stocks or sectors. But what about diversifying between stocks and bonds? Conventional wisdom tells us that stocks always outperform bonds in the long run. But guess what? History tells a slightly different story. While stocks have indeed outperformed bonds more often than not, it wasn't always a slam dunk. In fact, prior to the 1900s, it was almost a coin flip between stocks and bonds. Why? Well, there could be a few reasons. Maybe it's because the stock market was newer and less popular back then. Or maybe it has something to do with the fact that, believe it or not, there was actually deflation between 1793 and 1900. That's right, money could buy you about 15% more in 1900 than it could in 1793. Try imagining that in today's world. The point is, while stocks have been the clear winner in recent history, there's no guarantee that will always be the case. So, keeping some bonds in your portfolio might not be such a bad idea after all. Lesson number 4, the power of rebalancing. Speaking of stocks and bonds, let's talk about a powerful strategy that doesn't get enough love, rebalancing. Here's the deal, stocks and bonds often move in opposite directions. When stocks are up, bonds are often down, and vice versa. So, if you regularly rebalance your portfolio, say, once a year, you're essentially forcing yourself to sell high and buy low. It's like having a responsible adult in your financial life, making sure you're not getting too caught up in the excitement of a bull market or the despair of a bear market. And the best part? Historically, there hasn't been a huge price to pay for this added stability. A portfolio split 50-50 between stocks and bonds has historically returned only slightly less than an all-stock portfolio, but with significantly less volatility. For those of us who get a bit queasy with market swings, that peace of mind can be worth its weight in gold. Lesson number 5, past performance doesn't guarantee future results, but it's still pretty interesting. Now, let's address the elephant in the room. Just because something happened in the past doesn't mean it will happen in the future. The stock market of 1792 was a very different beast from the one we have today. For one thing, the market got off to a pretty slow start. Returns in the early decades were pretty underwhelming compared to what we've seen in more recent times. It wasn't until the 1860s that things really started to pick up steam. And let's not forget, the world is a very different place now. We have technology that would have seemed like magic to investors in the 1800s. We have a global economy that's more interconnected than ever before. And we have challenges, like climate change and artificial intelligence, that those early investors couldn't have imagined. So while it's fascinating and valuable to look at this long-term data, we also need to remember that the future might not look exactly like the past. The key is to use this historical perspective to inform our decisions, not to blindly assume that history will repeat itself. So there you have it, folks, some key lessons from over 2 centuries of stock market data. Let's recap. 1. Patience pays off. The longer you stay invested, the better your chances of making money. 2. Crashes happen, but they're usually not as bad as we fear. 3. Diversification isn't just a buzzword, it's a time-tested strategy. 4. Rebalancing can help stabilize your returns. 5. History is interesting, but the future might be different. Now, I want to hear from you. What surprised you most about this long-term market data? Have these insights changed how you think about your own investing strategy? Drop your thoughts in the comments below. And hey, if you found this journey through financial history interesting, why not share it with a friend? Until next time, this is your finance virtuoso guy, reminding you that in the world of investing, sometimes the best way to look forward is to look back. Stay curious, stay informed, and keep investing in your financial education. See you in the next video.